Okay, welcome back. We're actually going to be starting a new unit on credit cards and purchases using credit cards. So what we're going to do today is actually look at a lot of terms that you'll need to know if you eventually are going to have a credit card account like most people do today. Okay, so if this is going to start off with a lot of terms, and it really is important that you understand these terms. Most of them you probably, or some of them you might know, some of them you might not have heard of, but it is important that you know what each of these words means. So first of all, what is a credit card? A credit card is a card, a little piece of plastic. You keep it with you in your wallet, and what it does, the whole point of a credit card is it allows you to buy goods and services now and pay for them later. It's similar to having a check, but it's even easier than having a check because you don't have to write anything. You simply hand it to whoever you're buying the good or service from. They swipe it, it comes back to you, and you get whatever you have asked for. Now, credit cards can be dangerous because the idea that you have to pay later, sometimes people don't realize this, or they realize it, but they don't really think about it while they're buying these things, okay? So you get to buy the goods and pay later, but that in itself can be very dangerous. Sometimes what a store will do is they will give you what's called like a store credit card and set up a charge account. This means that this credit card specifically for this store is a line of credit. A line of credit means that they will allow you to buy up to a certain amount of goods with a credit card. So a line of credit, a charge account is a line of credit. It means you can spend up to some max amount at a particular store. So sometimes you have store-specific credit cards. An account statement is a record of all of your charges and payments on your credit card, everything you've used the credit card for, whatever you've bought with it, if you have any late fees, anytime you've made payments on it, the company that you have the credit card through, whether it's a bank or a store, will send you a statement that shows how much money you have how much you have bought using the credit card and all the payments that you've made on it. So it's very important. Your account statement is basically your history of using the card. Now, where people get into trouble is they forget to pay off or they can't pay off their credit card. And what happens in that case is you might incur something called a finance charge. That's just interest that is charged if you do not pay the full balance on your credit card. So if you don't end up paying, if you put money, if you spend money and you make purchases on the credit card, you get the goods now and you don't pay it entirely off by the time that credit card payment is due, then you get what's called a finance charge. It's interest that is charged to you. Okay, this is not the same as bank interest where you're getting money. This is the credit card company saying, hey, you haven't paid your full amount that you owed, so now we're going to charge you even more. So obviously you don't want to incur finance charges. You want to try and pay everything off as quickly as you can with a credit card so you don't end up paying more money for something than you really have to. Previous balance is pretty obvious. It's the amount still owed on your account from the month before. If you don't pay it all off, again, suggestion, pay everything off to the best of your ability as quick as you can. Credit. When you see the word credit, that just means payments that you made to the account. We might even just call that payment, or reimbursements from returns. Let's say you bought something with a credit card, but then you didn't like it or it didn't work, so you returned it and got that money back. That would count as a return. That also counts as credit. That means money that either you paid to satisfy your credit card bill, or if you return something, there will be a credit on your bill. Minimum amount due. So a lot of times what people do when they get into trouble with credit cards is they put things that are very, very expensive on credit cards, okay, that you can't possibly pay off all at once. So if this is the case, let's say you put a very large, you bought something very expensive with a credit card, and you say, I can't pay all that right now. The credit card company will realize that, and they'll say, okay, yeah, that's, ideally you pay everything right now, but even if you don't do that, we're going to have you pay what's called the minimum amount due, the minimum amount of money that must be paid each month. Now the thing with this is you might see minimum amount due and think, oh, okay, that's all I have to pay. But every time you don't pay off all the money on your credit card bill, you'll keep incurring finance charges. And those finance charges will build and build and build until you end up paying much, much more than the item was actually worth. Okay, so just paying the minimum amount due can lead you into trouble because you will keep getting finance charges every month. Closing date is the last day of a billing cycle. A billing cycle just means credit card companies usually operate on a monthly basis, okay? You have to pay every, see how this was the minimum amount of money that must be paid each month? Credit card companies usually operate on a monthly basis, as in, here are your charges for the month here's what you bought for the month, here's what you owe, and you need to pay this by some date during the next month in order to pay off your bill. Okay, so closing date just means the last day that you can incur charges before the new month begins. Grace period means a period of time, usually a couple days, when you're not charged a late fee. Credit card companies realize that accidents happen, real life can get in the way. Maybe you're a little bit late with payment. They'll usually give you a few days, especially if it's like a first time, they'll usually give you a few days where they're not going to start charging you a late fee. But if you go past that, you can definitely expect a finance charge or a late fee. Okay, let's see here. Annual percentage rate, APR. You might hear this on commercials a lot of times talking about low APRs. The interest rate as a percent that you are charged for borrowing money from the credit card. Okay, the interest rate that you are charged for borrowing money from the credit card. And I got one thing to add here, and we're going to add the term periodic rate. You might hear this word sometimes. The periodic rate is simply the APR divided by the number of times interest is compounded annually. Remember that word compounded. Again, we're talking about compound interest here, but this is not good interest. This isn't money that you're earning. It's bad interest. It's money that you have to pay because you haven't paid off your full amount that you owed to the credit card company. Okay? All right. So, that's a lot of terms. You're going to need to be familiar with all of those. And the main part of this unit, at least in the beginning, will be trying to take a look at your account statement, okay, the record of all your charges and payments on your card, and figuring out and trying to make sure that it's correct, okay? How do we figure out how much you owe? And really, there's only one formula for this, and it comes down here at the bottom. It says new balance, as in how much money you owe, equals your previous balance. Remember, that was the amount you still owed from the month before. Could be zero, could be a bigger number. Minus payments, minus credits, plus finance charge, plus new purchases. Now, it just seems very confusing. There's a whole lot of things being added and subtracted. This is why I say you really have to understand what all these terms mean. Your previous balance is what you originally owed. Payments are when you pay off some of your credit card bill. Credits are like we said, if you return something to the store, that means, well, you got that money back. Since you paid with a card, they're not going to hand you cash back, but you get a credit on your account saying, oh, you originally paid, we charged you $40 for this, but you ended up returning it, so we're going to give you a credit of $40. Okay, so if you were to go buy something else that's $40, that everything's even. Finance charge is your charge if you're late on your payment, plus any new purchases that get charged to your account. Okay, so I know this has a lot of minus signs and addition signs, so all I want you to think about when we're talking about this, when you read problems or descriptions of people's use of their credit cards, what you should always be thinking is this. What is this going to do to the amount that I owe? Will it increase the amount that I owe, or will it decrease the amount that I owe? If it decreases the amount that you owe, then you subtract. If it increases the amount that you owe, then you add. Let's see an example. So, let's go to the back. Example number 1. Okay. We have a previous balance of $322.45. We have a finance charge of $5.22. We have payments and credits of $50 and new purchases of $123.87. So, previous balance is how much you owed at the start of the month. A finance charge, that's money that you have to, extra money that you have to pay because you didn't pay off your total previous balance. So what does this do to the amount that you owe? They're charging you more money. This must get added. Payments and credits. You've paid off some of your credit card bill, or you've returned some stuff so you don't owe as much. This would mean you owe less since you're paying some of that bill off. You're decreasing your balance. And new purchases, obviously you're buying new things, that's going to add to your bill. So to figure out your new balance, you simply take your previous balance. Since the finance charge is more money you owe, we're going to add that. We're going to subtract the amount that you paid that decreases your balance with them. Okay, now you only owe $277.67. But you also bought $123.87 worth of new purchases. So your new balance is $401.54. And it's important to realize we're not talking, again, this is not a bank account. You don't have $401.54. You owe that much. You originally owed $322.45. Now you owe more, $401.54. So you've got to understand, are we talking about, when you get these problems and you're adding and subtracting, are we talking about a bank account that you own, this is your money? Or are we talking about an account you have with, like, let's say a credit card company where you owe them money? In this case, it's the latter. You owe the credit card company $401.54, okay? This is not a bank account where you have that much. That's the amount that you have to owe, that you owe to them. Let's go on to another example. Dante Green's charge account statement showed a previous balance of $157.80. So that's where we start. Let's just start by writing this stuff down. $157.80. So it starts at $157.80. A finance charge of $276. Remember, finance charge means you owe more money. You didn't pay all your previous balance off, so now you owe a little bit extra. It's like interest, but it's bad interest. So add $276. He makes two new purchases of $86.50 and $48.50, meaning he bought stuff using a credit card, so he now owes more money. He used the credit card because he didn't have the money at the time, so he put the purchases on the credit card so he can pay later. He did pay off $40. He made a payment of $40 on the credit card and a credit of $37.85. So he returned something, which meant he didn't owe that money anymore from the previous balance, so we subtract it. Okay, all I've done is I've gone through, and for each number I figured out whether it was adding or subtracting from his overall bill. So $157.80 plus $2.76 plus $86.50 plus $48.50 minus $40 minus $37.85. And it turns out that his new balance is $217.71. Okay? Two more quick examples. Malcolm Turner's charge account statement showed a previous balance of $270.49. And you can do these one at a time if you want. I kind of like to string them all out like this, just get it all done at once, but whatever works for you. So previous balance of $270.49. A finance charge, what does that do? It increases the amount that you owe because you didn't pay everything off last time, of $4.05. New purchases, putting new things on the card, $44.62. And a payment of $225. That means that he paid some of his bill off. So we subtract $270.49 plus $4.05 plus $44.62 minus $225. He now owes, his new balance on the credit card is now just $94.16. Okay, so he got his credit card balance to go down. Ideally, you want your credit card balance to be at zero as long as possible. Okay, you want it to be at zero as long as possible because that means you don't owe anything to the credit card company. Last one, Jeff Moore's credit card statement showed a previous balance of $921.07. That's the previous balance. We're going to write that down first. A finance charge of $13.80. Notice that finance charge is pretty big because he has a lot of money left on his account that he didn't pay off. New purchases, of $962.01, and a payment, he paid some of his bill, of $990.37. So let's figure out how much his new balance is, how much he still owes. He still owes, his balance is $906.51. So that's real quick, just an example of how to make sense of an account statement. Okay, we'll practice that a lot more as we go on, but what you really need to do is understand what all of these terms mean, okay, and whether they cause you to owe more money or owe less money. Okay, if you have any questions, please feel free to reach out. Tomorrow we'll be looking at actual account statements. Until then, I'll see you later. Have a nice day.